Hi, this is Alessio. Hope you're well and welcome to this video. In this special video, I want to talk to you about the 3 important trading mistakes that I've made so far this year in 2020. Now, some of you already know, after the crash in March occurred, when the stock market dropped by about 34%, I started buying into stock market. In fact, I started getting long and bullish about the stock markets, and eventually I sold my position after the rally occurred. I sold the majority of my position back in June. That trade produced a profit of about £90,000 or about $115,000. Now, at this point, you may well be asking, well, what's wrong with that? Where's the problem there? It doesn't look so bad, right? Well, here's the thing, guys. I want to show you the 3 important mistakes that I made in this trade. And I want to show you how I could have done this much better. And actually, it's possible this is something you might learn from as well. Now, before we begin, let me just mention that in this video, I'm going to mention a number of different stock ETFs that I'm buying or actually I bought in the past. But let me make this very clear. This is not a recommendation you should buy or sell any of the stock market ETFs that I'm going to mention in this video. I'm just letting you know this is the markets and stock ETFs that I'm actually interested in personally. And let me also make it very clear there are significant risks involved in all kinds of stock market ETFs. Okay, so let's begin with the first mistake that I made this year. The first mistake is this. As the markets began to drop quite heavily, about 34%, despite the fact that I saw severe oversold conditions, severe points of capitulation on the markets, the fact is that I would like to say to you that I was very calm in my head, that I was very relaxed, very calm, and I was slowly nibbling and buying into the stock market, perfectly relaxed, perfectly calm. The fact is, nothing could be further from the truth. While it is true that part of me was being rational and logical about the markets and seeing this as an opportunity, the other part of my brain was thinking, you've got to be kidding me. This is absolutely crazy. And essentially, yeah, there was a part of me that's absolutely frightened and panicking at that point as well. So let me just talk to you about that. One of my favorite hobbies, by the way, is reading books about neuroscience. So I read quite a lot of books on the human brain and neuroscience and, the anatomy of the brain and things like that. So essentially, it turns out that neuroscientists are saying that the way the left brain processes data is different from the right brain. In fact, studies show your left brain is the logical part of your brain, the rational part of your brain, whereas the right brain is the more emotional brain, the more sentiment-driven brain, if you want to call it that. So that means this. That means that during times of extreme market turbulence, like for example, a market crash, for example, human beings often become very irrational and emotional. And that is also true with me, by the way. So I don't want to try and pretend to you that somehow I was perfectly rational and unemotional during this market crash. What happened was this. As the markets began to drop quite heavily, and as I saw huge oversold conditions and points of capitulation in the markets, I began to nibble on the markets. Nibbling essentially is a way to start building a small position when markets are reaching essentially points of extreme oversold or extreme capitulation, and often when markets are becoming hated, when everybody's turning against the market, when the herd is turning against the market, that is also the levels I was interested in. So I began to nibble, again, buy with small positions in the markets back in March, and actually added to my position quite heavily back in April as well. Now at this point, you might be asking, well, where did I go wrong here? What was the mistake here? The mistake was simply that the right brain, my right brain, the emotional one, I think to some extent overpowered the left brain, the rational, logical one. Because here's the thing, guys. In any given situation, when you're looking at a chart of the markets, when you're trying your best to be, logical and rational, it is quite possible your right brain could overpower the left brain. Because what was happening was as the markets were dropping and crashing quite heavily back in March, so even though the logical part of my brain was saying, okay, this is a great opportunity, we're reaching capitulation territory, markets are extremely oversold, and very soon we could see a bounce. In fact, I said this in my videos, I said back in March that we were very likely going to see a bounce in this market very soon. So even though the logical part of my brain, the left brain, was saying, okay, this is a great opportunity, the charts are screaming, this is capitulation, and we're going to see a bounce very soon. The fact is, the right part of my brain was thinking, oh my God, are you kidding me? All the great professionals were saying, no, this market's going to drop even further. In fact, many of the great traders and investors out there that I respect were actually quite bearish on the markets. They were expecting the markets to drop even more. So when I was buying into the market back in March, I was acting pretty much against not just the herd, not just the average folks out there, but I was going against even some of the professionals out there who were wrong, by the way. I mean, most professionals out there were saying, no, this is not the best time to buy. The markets will drop another 20, 30%. So it seems even a lot of the professionals out there were also quite bearish and wrong on the markets back in March. So you got to appreciate, guys, that when you're trading the markets, to some extent, you have to act and think alone. Sometimes your analysis may diverge from some of the folks out there, even professionals out there, and sometimes you might disagree with them. And this is where essentially your right brain, your emotional brain, could very well say, hey, you know what? Maybe it's not the right thing to buy into the market. Maybe we're making a big mistake here. So that's why, guys, to some extent, I think emotion, the right brain, was overpowering the left brain. And the mistake I made was that I did not buy as much as I should have done. So even though I did buy into the stock market at the right time, the fact is I don't think I bought enough. The emotional right brain essentially to some extent overpowered the left brain. And I think that's quite disappointing because the logical part of my brain was saying, no, everything in the chart was screaming, this is a buying opportunity. The market very likely could have a reversion to the mean, a bounce. So I think the one thing I regret doing is that I did not build a bigger position, which I could have done. So even though I would like to say I remained objective, rational, and logical, guys, the fact is not true. There was a part of me that actually was frightened and panicking because at the beginning of the trade, I did go into negative. So this is the thing, guys. You have to appreciate that trading has a huge psychological element to it. So the one lesson from this, guys, is this, that make decisions based on what you see, not on what you think, not on how you feel. And if I had to give myself a score out of 10 on that one, I would probably give myself a 6 out of 10. Now, let me also make it very clear. I'm not saying that people should just, catch a falling knife. I'm not saying we should just jump in willy-nilly into the market. No, we should, of course, look for any kinds of reversal signals. Anything that might be indicating, hey, you know what? There's potentially a bullish reversal or the start of a new uptrend. Okay, let's go to mistake number 2. Now, this mistake has to be the most damaging mistake I made this year. You see, guys, it is not usually a good idea to buy into a lagging market. And it's not a good idea to put a significant amount of money into a lagging market. Let me explain to you why. For example, if you sat in an airplane and you felt turbulence, here's a fact that you may not be aware of. It turns out that you feel turbulence in an airplane much more in the back of an airplane than you do in the front of an airplane or in the middle. So it is true, you do feel turbulence in an airplane no matter where you're sitting. However, the intensity of turbulence is felt much more if you're sitting in the back. And that is actually kind of a good analogy when you're looking at the markets. What typically happens when the stronger market, like for example, when the US stock market has a pullback or retracement, the intensity of the drop is felt much more in the lagging market. So often the lagging market drops more than the leading market. And that was the mistake I made in the early part this year. You see, guys, I put quite a substantial amount of money this year into the UK stock market, which is the mistake I regret the most. No offense to our British viewers, by the way, but let me explain to you what happened. So after the UK FTSE 100 crashed quite heavily, I began to become quite interested in the FTSE because it was hated, it was very cheap, and also it paid a quite nice dividend as well. In fact, the UK stock market pays a nice dividend of about 5.95%. Dividend per annum, which is quite a lot more than some of the other ETFs out there. For example, the US stock market ETFs like SPY pays about a dividend of about 2%. So here's the thing, guys. I think the dividend payments on the FTSE 100 perhaps tempted me to put more money into it than I should have done. What I should really have done is actually put a lot less money into the UK stock market and put more money into the US market. And actually one other market, which I'm going to mention to you in this video in a few minutes. The fact is I put about 25% of my position into the UK stock market, into the VWRL ETF. And the problem is this particular market, the UK stock market, underperformed the US market. In fact, the performance of the UK stock market this year has been just abysmal. It's just been absolutely frustratingly terrible in my opinion anyway. And notice from this chart, the UK stock market underperformed not just the US markets, but also underperformed the European markets as well. So this was very frustrating, by the way, guys. So I did not enjoy this one bit. So this is one market I probably will be avoiding in the near future. Now, don't get me wrong here. I'm not saying that I want to have zero exposure to the UK markets. No, in fact, there is actually a better way that I could have done this, as I will show you in a few minutes. All right, guys, let's go to mistake number 3. You see, guys, there is one key market that I ignored throughout this entire journey, throughout this entire rally. The one ETF that I perhaps should have bought and I ignored was the world. Yes, guys, the world stock market ETF. You see, guys, one key mistake which many investors and traders seem to make is they seem to focus only on the market that is related to their own country. So for example, people who are in the UK mostly focus on the UK stock market and ignore the rest, ignore the US or Europe. For example, people in the US mainly focus on just the US markets and ignore the rest of the world. And I think this is actually quite a big mistake because many professional analysts actually say that the one market we should not ignore is the world market. In other words, rather than just investing or trading in just one specific market, the UK or the US or Europe, it's good to have exposure to the entire world. But the question you're probably wondering is, well, how do you do that? So guess what? There's actually a number of ETFs out there, stock market ETFs, that give you exposure to the world. By the way, if you're not familiar with this term ETF, all it means is that you're investing in a basket of stocks. So you're not just buying one specific stock, but rather you're buying a basket of stocks, which is diversified among many different stock markets out there. So let me talk to you about one specific market out there, one specific ETF, which I'm considering buying in the near future. This is called VWRL. VWRL is the FTSE All World ETF. And this is very interesting because this particular ETF, VWRL, gives you exposure to North America, as you can see here, so the US, about 59%. Then you have Europe, about 17%. And then you have Pacific and emerging markets. Because guys, emerging markets like China, India, Russia, these emerging markets could very well grow and expand in the near future and could play a bigger part in the world. So I think from a trading or investing perspective, I think, again, personally for me, I'd like to have exposure to these markets, to the emerging markets. So that's why this particular ETF becomes very useful. And look at this. You actually get exposure to different countries, as you can see here. So you have exposure to the United States, the US, 57%, Japan, China, about 4%, UK. So this is very interesting, guys. With this particular ETF, you already get exposure to the UK markets too. So that goes back to my second point that I just made earlier about the UK markets as well. So you have also exposure to Switzerland, France, Germany, and we just go down the line over here. Australia is here as well. And very interesting, India, about 1% to India. And then you have Russia. I mentioned Russia before in my videos as well. So this is a very interesting ETF. By the way, let me just mention this. If you're in the US or Canada, the ETF that is very similar to this, not the same, but similar to this, is called VT. And VT, this particular ETF has a very similar diversification among different world markets. So you have exposure to the emerging markets, again, China, and of course, Japan, UK, and European markets as well. So that, guys, comes to my third mistake, because what I did was I bought the US markets and I bought the UK market. What I should have done is buy the US and the world markets. So I think I was right in buying the US markets. In fact, the majority, the biggest part of my position was in the US markets. VUSA was the biggest part of my position. However, instead of putting 25% into the UK stock market, what I should really have done is put that money into something like this, into the world stock market ETF. Because that particular ETF, by the way, outperformed the UK stock market on its own, as you can see here from this chart. And in fact, the performance of this particular market, again, VWRL or indeed VT, was actually a lot better than just buying the UK market, or let's say buying just one particular country ETF. So again, a huge benefit of this is having exposure to these different world markets, especially emerging markets, which could play a big part in the very near future. And of course, the US markets and the European markets as well. By the way, guys, what I'll do is I'll put the links for these particular ETFs for you in the description. I'll put them for you here on the screen as well. And if you like, you can check them out and understand the full risks that are involved in this particular ETFs. All right, guys, I'm hoping this video has been of some help to you. And if it has, please give it a thumbs up. And also, please subscribe for future videos as well. Thanks a lot, guys. Bye for now. Cheers.